in particular, we're focusing on investing ethically. So welcome to this online seminar. It's the third in our series of 10 weekly seminars. We're going to kick off the discussion for about 15 minutes, maybe a few minutes more, and then we'll open up for questions. Sorry, we've got you on mute, but if you can use the chat function and put your questions in there, that would be great. And you can send in your question at any time. You don't have to wait till we start the formal Q&A part of the meeting. My colleague Toby is also harvesting a few questions from Facebook Live, if we get Facebook Live going. So let's kick off. This week we're joined by David Beattie. Welcome, David. David's principal of Booster Asset Management. And I saw on your CV, David, that you're celebrating 20 years with Booster.
Indeed, I am.
So fantastic. Congratulations and welcome.
Thank you.
So to kick off, Booster's been a leader in providing ethical options for New Zealand investors for quite some time. Can you sort of paint us a picture of Booster's approach to ethical investing and maybe a little bit of the history of that over time?
Yeah, sure. Thank you, Barry, and thank you for the Mindful Money team for arranging this webinar and inviting us to share our thoughts and experiences, and welcome to everyone who's joined. Booster first became meaningfully involved in responsible investing about 10 years ago when we bought the Astron KiwiSaver scheme, which included a socially responsible investment fund that excluded investments in the four sort of fairly standard industries at the time: alcohol, tobacco, gambling, and weapons. It was a very small fund and represented only about 1% of total investors, but we decided to commit to understanding a bit more about the whole area of responsible investing, and so our real journey began then. A few years later, in 2014, we bought the Fidelity KiwiSaver scheme, which also had an ethical fund as one of its choices. So we sort of found ourselves almost cornering the ethical market by default. And so we naturally started to receive a lot of interest from the broader ethical market, as well as from a whole lot of newly acquired ESRI fund members. And so based on that and their very clear preferences that they were communicating to us at the time, 5 years ago, we added a quite broad-based fossil fuels exclusion, which covered not only just the extraction and production, but also distribution, supply, and retailing. And we even removed some Australian supermarkets, which earned more than 35% of their revenue from selling petrol. So we were able to define our own exclusions to suit more investors, because we've always had the capability to invest directly in stocks, and I'll talk a bit more about that later. So you can see on that slide, there are now 9 industries that we don't invest in within our 3 multi-sector SRI funds. These are all certified by the Responsible Investment Association of Australasia. And just one thing to note on here, which we'll talk a little bit more about later, but the fossil fuels picture on the bottom left doesn't actually have the word production after it, as we expanded our definition beyond that, as I said previously. And it's sort of worth noting that a lot of fossil fuel exclusions around the world are actually limited to production only. So our wider definition is unique in New Zealand, if not in the world.
Cool. Thank you, David. So one of the things that prompted this series was the fact that we started seeing very good results coming in from the ethical funds that are on the Mindful Money website. So those good results, we eventually did a kind of analysis of how that looked overall. And I'll just show you how that looks, because it's kind of an interesting outcome. So if we go to this is a comparison of the KiwiSaver funds on the ethical funds on the Mindful Money site. We call them kind of mindful funds with other KiwiSaver funds. And what it shows is that the outperformance on conservative funds was relatively small, but got significantly greater with regard to growth funds. And why this is important is because this has been echoed not only for New Zealand but internationally in the performance of ethical funds and in research over long time periods. But I wanted to so that's the picture overall, and I thought I'd give David a chance to talk about Booster's own performance over the past quarter.
Yeah, thank you, Barry. You're quite right. The last 3 months has been particularly fruitful for funds that have taken a responsible approach by excluding some particular industries. So what I've decided to do here, because we've got the benefit now of some longer term data, and the more information you've got, the more conclusive can be some of the findings. So what I put it back in here is, so those average bars in grey are actually quite a good proxy for the overall market index return, and they line up with the averages that you just put up on the previous slide. So they're a good proxy, as I said, for sort of the overall market index return. And I've added simplicity in there in the orange bar, not because I want to particularly directly compare one provider's set of returns with another, but because simplicity's returns are actually a good proxy for what you might call an ESRI market index return. And to Simplicity's great credit, they've set the standard on cost-effective passive ESRI index investing. I've added the 3-year numbers now, so we can start getting a bit more of a medium-term picture. Unfortunately, Simplicity's only been going for 3 years, so that's all the data we've got. But even though it's only 3 years, the data is still quite informative. So if you have a look at the right-hand bars for the 3-year period, there's about a 1% difference between Simplicity as the market proxy index return for SRI and the KiwiSaver average, which is the overall market index proxy. So 5.3% versus 4.4%. So that 1% difference is effectively showing the additional return per annum that investors have received from being in an ethical style fund over the last 3 years. And in the last year, you can see that difference was actually closer to 2%. Now, over both those periods, more than half of that positive additional return has come from not owning fossil fuel companies, with the remainder sort of broadly down to not owning emerging markets, and from the gains received by investing more in healthcare and technology sectors to replace the fossil fuel companies removed. So our SRI funds have captured all of that value from the core index funds and strategies that we also use. But importantly, our philosophy has always been to combine the best of passive index investing as a core of the portfolio with active satellite strategies that add value. Obviously, active management costs more, so we've got to be able to demonstrate that it adds value after fees over time.
So let's talk a little bit more about that, because I think that's important. And the question this begs is so how do you do it? It's kind of like everyone in the finance industry is searching for alpha. What's the additional excess return for the same amount of risk that you can get? And there is now, not only from your performance and the quarterly performance, but over a longer period of time, we can see that there's a good return, generally higher return for ethical funds. That's a really important alpha. So what's the secret? How does this happen from your analysis of investment portfolios?
Yeah, so the active piece, as you might have recalled from that last chart, was about 0.5% per annum net additional return after fees. And I think that's a reasonably good proxy for the sort of long-term average target that a good active manager should be aiming to deliver after fees. Fees are obviously a very important concept, but it's returns after fees that are even more important. And obviously, with a higher net return, you'll have more money. But the active management is particularly valuable when markets go through the sort of economic and financial downturn that we're currently experiencing. I don't know whether you can bring up that chart again, but it doesn't really matter. On the 1 year bar in the middle, our SRI fund generated more than 2% more than Simplicity's index-only SRI return. So you can see that number 3% versus 0.8. So it's about a 2.3% difference there. And overall, 4% more than the market average. So that 2% difference between the market average and the Simplicity represents the added value from the broad ethical fund exclusions, and the other 2% is from the active management. So we use a couple of very key managers in our global share portfolio, and that's where most of that has come from our perspective. We use Fisher Investments in California and Rothschilds in Switzerland. Now with Rothschilds, we've had an exclusive advisory relationship with them for nearly 15 years now, and they help us to put together a portfolio of about 20 stocks, which we've got up there now, with an overarching SRI exclusion filter. So there's no stocks there that are in one of those 9 industries we saw earlier. And if you have a look at this chart, it's showing the performance of each one of those 19 stocks relative to the market index. And in fund management circles, I think that chart's quite remarkable. I want to explain why that is. You know, most fund managers are pretty happy to have around 60 to 70% of their active stock picks outperforming over this sort of time period. But for the year ended March, literally every single one of those 19, in other words, 100% of the stocks that we actively selected with Rothschild's advice to include in our SRI KiwiSaver funds has outperformed. And collectively as an active overall portfolio, they've delivered 20% more than the world market index. You know, you almost don't care what fee you're paying to get that sort of result. No doubt there's some familiar names in there and not so familiar names in Microsoft, no surprise, 50% better than the world index. And also interesting to note that the worst of the outperformers was actually Warren Buffett's listed Berkshire Hathaway fund. So, you know, at that level of outperformance, this is not luck playing a part in this. This is being patient and committed to active management and knowing that it delivers its best work when the markets are volatile or hit by the sort of shock we're in now. And you just don't see that sort of level of and consistency of outperformance when the markets go up. So I think the really important message from this is here now, it's very clear that the future return opportunities to active stock selection is higher today than it's ever been in any time in our recent history. And with real pressure happening at the corporate level in this environment we're in, the ability to be able to make distinctions between different underlying companies and securities is going to be a source of real return for KiwiSaver investors. And passive investing is fine in a low volatility environment, but not so much in situations like we're in today, where you have no control over avoiding investments in companies that might not survive and no ability to pick winners. So that's the reason why we're really strong believers in combining passive and active together.
Good. Thank you, David. You're sandwiched between Simplicity, who was on last week, and Merriome, who's on in a couple of weeks' time, and both of them would say, look at the data. The data says that passive funds overall perform better, so you know, how do you look at that? Is this particularly because the combination of active and ethical investing is good, or are you just saying that some active managers are able to consistently beat the market?
Yeah, some are. And the average passive fund beats the average active fund, and I think that's clearly evident when you look at overseas markets. I think one of the other interesting things that we see from New Zealand, and one of the many benefits of being a little isolated nation down here is, you know, typically our portfolios are spread all around the world, and we don't have a natural local bias. The New Zealand market's pretty small, and so we're forced to look around the world quite dispassionately. Whereas I think in the States, where there's a lot of data supporting the notion that passive is derives better returns over time, it's a highly competitive market. There's a lot of players there, and I think sometimes they get blindsided by their own internalization and the look of things, and they don't have that global perspective. And New Zealand-based managers, I think we've been forced to look globally, fairly objectively at the whole thing. And I think if you focus very much on a very clear philosophy you've got and stick with managers like we have with Rothschilds for 15 years, over time, and certainly right now, I think the active managers who do outperform really come to the surface.
Okay. So let's move on to a kind of somewhat related topic. Um, Almost all of the KiwiSaver funds are 100% invested in listed stocks, either equities or bonds. Booster's been one of the ones who's been a bit of a sort of trailblazer on unlisted investments. Can you talk through what you've done with Tahi and with the Land and Property Fund, and talk through sort of what your thinking is around that?
Yeah. So it was nearly 3 years ago now we created the Tahi Fund as a vehicle to be able to direct some KiwiSaver money towards unlisted small to medium-sized businesses in New Zealand. And it seemed like a match made in heaven to us, with Kiwi money supporting Kiwi business, particularly because KiwiSaver is a long-term retirement savings vehicle with regular positive cash flows, which can easily handle having some of the investments in companies that you can't typically liquidate in the short term. We've done some pretty brutal stress test modelling on worst case cash flow liquidity scenarios and falls in the liquid share markets, and determined that a 5 to 10% allocation to unlisted doesn't put any significant stress on an overall fund liquidity. So in our view, lack of liquidity is not a valid reason to not add unlisted investments into KiwiSaver, but unfortunately it's often used. But because people can move in and out of KiwiSaver daily, the main things that need to be sort of dealt with well are making sure you've got a robust process and methodology to be able to price these investments and accrue their underlying cash earnings daily. And I won't risk boring everybody with the details of how we do this, but suffice to say that the external auditors and independent supervisor are very satisfied with how we do that. So in terms of the sort of type of companies we're looking for, we're attracted to successful businesses with a track record of profitability. They've got a sort of clear competitive advantage, typically with an exportable product or service, and competent business owners with a clear and united vision for growing their business, and people we can work alongside as partners. So we're sort of usually looking to somewhere between a 25 to 49% equity exposure. So we want to keep control with the existing business owners, and also importantly, typically we don't have an exit strategy. We're there for the long term. So yeah,
good. And just a quick one. What sort of exposure do you feel you can have to unlisted stocks while still maintaining liquidity in KiwiSaver funds? So are we talking sort of 2%, 5%, 10%?
Yeah, so that stress test said that 5 to 10% doesn't put undue pressure on the fund. So, if you took 10% of the entire KiwiSaver money of $60 billion, that would actually open up $6 billion available to invest in small businesses in New Zealand, which would be a fantastic way of supporting them. But we obviously can't force every other KiwiSaver to do the same as what we're doing, and we'll just plow on doing what we're doing and knowing that we're doing the right thing, and we're buying companies cheaper multiples typically than what you can on the listed stock markets.
Great. So please enter your questions into chat. We're about to answer a few questions with David. So before we do so, just one final one, David. What's next for Booster? Where are you going? What gets you excited?
There's a couple of things. Well, just on unfortunately the Tahi and the private property fund, we don't have an ESRI KiwiSaver funds because of alcohol exclusions. And if you know about what we've been investing in, typically our first forays were into vineyards and winemaking businesses. So we've had to exclude them, and we'd like to be able to solve that into the future to be able to put it in, but it'll be a tricky one. We did think about canvassing the members to modify the alcohol exclusion to include bottled wine, but we pretty quickly realized that most people wouldn't be happy with this. Even though some of our SRI members actually contact us to get hold of the shareholder wine discounts. I think at the end of the day, it's better to just leave members to make their own choices, and probably explains why we actually have quite a few members who've got both SRI and non-SRI choices within their portfolio, so they get the best of both worlds.
Okay.
We may do a little bit of more work to see if we can't get some private investing into the SRI funds, but not going to be easy. couple of other things we're working on actively. The first is when we removed fossil fuels a few years ago, we found some of the limitations on external fund choices with a fossil fuels exclusion. And in a nutshell, this wasn't changing quickly enough for our liking. So we've decided just recently that the only way we can have full control over our SRI fund exclusions was to shift everything we practically could out of those funds and into investing directly. So we've just done that with the exception of global bonds. And the other good thing about having total control over your direct investments is that we can now seriously have a look into those other areas that Kiwis now have very much top of mind, such as animal welfare and human rights. One of the many challenges with these is that these two areas themselves are quite unlike the other 9 exclusions, which are actually clearly defined industries. There's no such animal cruelty industry per se, so the approach has got to be different, and it's only really achievable, I think, properly through direct investing. So we're looking forward to working with you a bit further on that and on how best to define and implement those types of exclusions. The other thing that we're just working on quickly is the integration of ESG, or environmental, social and governance framework, into our analysis across all of the funds that we manage, not just the SRIs. And we've now largely completed that as well. So adding a positive ESG approach across all the funds was a natural evolution in our overall journey, and we're working with the RIAA on having all of those funds certified as well.
That's great. Exciting developments, and congratulations for that. For those of you who are interested in those exclusions, we've got a way you can look at what's in your KiwiSaver by going to Mindful Money's website, www.mindfulmoney.nz. We'll put it in the chat, and you can see what's in your KiwiSaver, and you can also look for an ethical fund and find great funds there, like Boosters funds. So thank you for that, David. We'll go to questions, but at the same time, we would quite like to ask you a couple of questions. So we've got Zoom has this lovely polling mechanism, so we're just going to send you a little poll. So if you can answer that while you're thinking of your question, that would be great. We've got a question from Tom on Facebook. And he's talking about the data on quarterly earnings, and the fact that our data shows that ethical funds did well over the past quarter. And he said, don't you think there's a risk of short-termism by using measures like that? I think, David, you partially answered that with your chart showing 3 months, 1 year, and 3 years. But do you want to comment on sort of how ethical investment tracks over sort of short crisis periods like we're in at the moment versus the long term in terms of relative return?
Yeah, I think the world has been permanently shifted off its axis a little bit with what's happened recently, and as I described before, just an overall approach to active management, I think, is going to provide a very strong addition to portfolio value over the next foreseeable future, anyway, a few years. The whole responsible approach, I think, is a twofold measure. Whilst I think the development of responsible investing has its roots in an exclusion type approach, as we sort of briefly touched on at the end there with the next evolution, I think is actually properly and fully integrating ESG investing into portfolios and not just paying lip service to it, but actually pulling together a proper full assessment. And I think interestingly, from our perspective, rather than just saying, well, not having fossil fuels will pay off into the future as much as it has in the past, I think there's obviously going to be a point in time when fossil fuel companies and the oil price reach a really low point, and obviously a lot in the industry will struggle at that sort of price and will probably go out of business. But I think it's important sometimes to remember the normal economics of supply and demand work, and eventually there is going to be a point where the value is so good that the fossil fuel companies may actually, for the next 5 or 10 years, do quite well. for an interim period. And I think also it pays to bear in mind that whilst it's admirable and terrific to follow through on your views on fossil fuels by excluding them from your investment portfolio, it's demand and supply. And the fossil fuel companies, most of them are not run by people who don't give a damn about climate change. For some of them, it's all they've been doing all their lives. And you look at some of the companies, they are committed to try and work out ways of finding alternative energy sources. And sometimes the best way to make those sort of things happen is to positively engage with the ones that are clearly signaling that they understand the limitations of a continued reliance on fossil fuels and focusing on alternative energy. And some of these companies actually have huge R&D budgets to actually make a meaningful difference. So sometimes just engaging with the best of those companies can make just as much a difference than taking I'm just going to vote with my feet and take my money out approach. Plus, just add from a personal perspective, I think we all have to do our part. As I said, fossil fuels and oil prices are just a simple matter of supply and demand. And while people still demand petrol to drive their cars and fly everywhere around the world, these companies have to keep producing fuel. So they're just responding to demand. And the bigger message to all of these companies in terms of accelerating the speed at which we move to alternatives is to stop demanding it. So I think we all have some personal responsibility in terms of our consumption habits as much as we do on investment habits.
Absolutely. Not just a question of leaving it up to the fossil fuel companies to go out of business. Mind you, at minus $37 per barrel on spot markets, it might be sooner rather than later that there's some mass bankruptcies across the sector.
But unfortunately, not going to be flying anytime soon if that's the case.
Yeah, we've got the results of the poll here, which are kind of interesting. I'll just share those. And what it says is that over a quarter of you are thinking about switching to an ethical fund. Not everyone immediately, but at some stage. And 60% have already switched to an ethical fund already. So thank you for those results. That's great. I'm going to move on to a question from Paul Richardson. How are you doing, Paul? The question is, if New Zealand allowed large withdrawals from KiwiSaver as the Australian government has done, how would that impact the allocation to illiquid direct assets? So would you see, for example, it being much more difficult to hold unlisted stocks, and have you done any stress testing on it?
Well, yeah, we've done stress testing on holding. Does that make any difference? No, I'm going to turn that off. We've done some stress testing on the liquids, and we've only got about 4% in our portfolio, and I don't think any other KiwiSaver funds have got anything meaningfully more significant than that. So it's really a non-issue at the moment, and even at 5 or 10%, I don't believe it would be significant. You could take, I think Australia allowing people to take up to 10, I think the number's about 10 to 15% of the funds may potentially be taken away. I think the biggest challenge for the industry, if that came in here into New Zealand, hypothetically tomorrow, the KiwiSaver providers, quite frankly, are not geared up to process that volume of withdrawals in a short space of time. You just could not do it. There's 3 million members in KiwiSaver. There's not one single KiwiSaver provider who could go into the office and process 3 million withdrawals of just 10% of the funds. So the liquidity in the funds is not the issue. I think it's the administrative capability, and I suspect we'll find out how the Australian super funds are going to cope with that over the next few weeks as people are rushing to get their money out. So I think that's more of a challenge than the actual underlying investments, which I have no worries in terms of the liquidity side.
Okay, thank you. Shanina asked a question on, can you sort of clarify from Booster's perspective what you mean by ESRI and how it relates to the split between active and passive investments?
So ESRI is a terminology that's been around for a long time, and most people understand socially responsible investing from its origins, which was simply a negative exclusion filter. And back in the good old days, typically the exclusions were, and they have some background. I think they originally started from some Catholic funds, so they really had excluded alcohol, tobacco, gambling, and weapons, and they were always just the four standard ones. So it's expanded from that, and they call it socially responsible because those were sort of the social areas that people had a particular value tilt away from. So it's expanded more now. With, I mean, fossil fuels technically isn't really a socially responsible investment fund option. Excluding fossil fuels is more of an environmental responsible investment. So it should be an ERI, but nevertheless, there's been some confusion about some of the labeling. And then, of course, so once you're into excluding things, there are a couple of ways you can do it. Either passively by just following some index funds that exclude the same things, but you are driven by a very close relationship you must have with whoever's providing those index funds to make sure that the exclusions that they're putting across line up with what you want to exclude. And as I alluded to, sometimes they don't go far enough in terms of what you want to do. So in that way, it's better sometimes to include some active exclusion management as well. And there are other providers. I think CareSaver you've had on here a couple of weeks ago with John, and they are pretty much 100% active. So they don't use any index funds at all. Their entire portfolio is actively selected, and they've got total control over what they can and don't invest in. So we're somewhere in between the two. We've got we like to think we're picking the best of both worlds.
Okay, and Janina also says this outperformance so you get from ethical investing and sort of active investing. Do you kind of tell people what additional retirement funds that would get them after a certain period? What sort of metrics do you use to tell people that in a way to boost the booster?
We don't, if I'm understanding the question correctly, we don't differentiate from a long-term return expectation perspective between a responsible fund being the SRI and the non-SRI. Over time, one would, people going into responsible investments, I think would like to think and hope that there may be some material difference. But ironically, the reason why I think a lot of people haven't is because up until recently there was a widely held view that in order to go into an SRI or responsible investment fund, you actually had to give up some return. So we've come a long way, I think, to at least get people up to the point where, look, you can follow funds that match your values without having to give up additional return. I'd be hesitant to say that there's any rationale for suggesting that investing in responsible investment funds now has taken the next step of guaranteeing you get a better return for some of the reasons I touched on earlier. I think the most significant thing that's likely to happen going forward in a development sense is a blurring between what traditionally have been sort of fairly blunt, just negative, take a whole lot of stuff out, good, bad, and indifferent, without sort of getting too careful about the selection, but applying a positive filter. So I think combinations of positive ESG integration along with some obvious clear exclusions that need to be taken out is the way forward, rather than sort of one or the other. And I think we'll find that the best products going forward will bring all those two things together in a way that people are not having to be forced to try and work out which type of approach is going to perform better than the other. The whole industry will have a genuine responsible investment thematic behind it, and I think that's a better outcome for everybody. Some will be quicker to do that than others.
Okay, we'll take one more question because we're pretty much close to time. As it gets a little bit more complicated to manage for climate change, fund managers are going to be asked to make some nuanced judgments around beyond, who produces fossil fuels and who explores for them and so on, into issues like, the use of plastics in the different industries and should you be excluding companies that are engaged in that, or in the use of oil-based products like tarmac and construction. And so, you know, it's going to be much more research driven. So how do you see fund managers being able to cope with this while keeping reasonable fees?
Yeah, you're right. It is quite research intensive, and it's not something you can brush over, lightly. And the more we've actually got into this, the more we've realised there's a wide range of alternative ways of approaching it, and there are a number of organisations who are doing some very good work on assessing companies on their environmental, social, and governance capacity and what that might mean going forward. But the problem we're finding is that there's not the level of consistency across even so-called experts in that area to be able to confidently just select one versus another. And as soon as you combine two together, they all have their different views and approaches, and the more you get into this, the more subjectivity. So I think in the end, fund managers who are serious about this, whilst I'm not advocating they don't buy or get in any external research, because it's usually a good check and a balance, but as we've done ourselves, you've got to build your own process for assessing it that's consistent with what your own investors are looking for. And I think if you went all around the world, you'll get different investors have different views on all of this, depending on which country you come from. Case in point, I think Australia, there's an economy there that's very reliant on fossil fuels, and so you've got to be very careful how you talk to your typical Australian superannuation fund members when it comes to removing fossil fuels, because so many of them are reliant on that industry for their their livelihood. So different jurisdictions have different approaches. I think New Zealand, we're very fortunate that we've got a heavy reliance on hydroelectric sources of fuel, far less reliance on fossil fuels, so we can be a lot more aggressive. Now, so from a New Zealand perspective, we've got to design that ourselves, and we've got to look from a New Zealand perspective as to around the world as to what suits us. And the more you're relying on external sources, the more you realise that there are 1,500 different ways of addressing it. And as we've seen, it explains why trying to find an off-the-shelf solution is somewhat problematic. So challenging, but a good challenge, I think, to have, and it's not insurmountable, but you've got to apply some resources to it.
Great. So everyone, if you can stay on 2 more seconds, we've got a final poll for you, because we're just not 100% sure of what time for these seminars is really suitable for everyone. So if you can hang on for just a second, here's the poll. So if you wouldn't mind filling it in, that would be really helpful. So thank you very much for joining us. Sorry to anyone who's tried to do it on Facebook, and we just somehow Facebook got really busy and couldn't take the link from Zoom. So we'll make sure we sort out the technical snafus before next time. Huge thank you to you, David, for joining us, and that was a really interesting discussion, and you guys are obviously doing great work, so congratulations. For those of you who are interested in finding out more about ethical investing, looking at funds, come along and have a look at the Mindful Money website on www.mindfulmoney.nz. Next week at 4 o'clock on Thursday, 7th of May, we're changing gears a bit, and we're talking to Brian Henry, who's head of the only Islamic ethical fund in New Zealand, in fact the only Islamic fund, called Amana. And they've had just a stonkingly good last quarter in terms of their results. And the interesting thing is the kind of overlay of the Islamic principles on ethical investment. So it'll be a really interesting discussion. I hope many of you can come back at 4 p.m. next Thursday. If we look at the results of the poll, sounds like 4 p.m. Thursdays is pretty popular. So hopefully you can come back and join us. Thanks again to David. Thanks for joining us, and have a really nice kind of level 3 kind of evening. Thank you.
Thank you,
Thanks, Barry.
Cheerio.